Hey everyone, my name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com, and welcome to this special edition of The Final Bar. Today we wanted to do just an all mailbag edition. It's been a lot of movement in the markets recently, a lot of uncertainty, a lot of differentiation between what's working and what's not. And as a result, in uncertain times, we tend to get a lot of questions in the mailbag. Our mailbag is overflowing. So what we want to do is spend today just going through a bunch of the questions we've received recently, going through them. I think it'll help you hopefully make sense of these markets through the questions that your peers and other StockCharts users and StockCharts TV viewers have been asking. Hopefully it informs you about the markets, illuminates the activities of the recent market movements a little bit better, and also helps you understand the StockCharts platform, how we can use it to better understand the world around us as investors. Let's get right to question number one. Dave, how does the new daily VIX differ from the old VIX? And I really appreciate that question. If you've missed this, there's been some activity, of course, with the VIX. My main VIX chart is this, and what I mean is there have been some new additions to the family of VIX indicators, I guess. This is the VIX that we've normally used, and while I'm updating the chart, you'll notice in the title it actually says Volatility Index New Methodology. So what I'll point out to you is this is not the first time or the last time when the good people at the CBOE have made adjustments to the VIX, have added new VIX indicators. We've had VIX futures and things that have sort of come in. So, this is actually not a brand new phenomenon. It's actually happened before, and the VIX switched to a new methodology. Ooh, I should know this. 15, 20 years ago, I want to say. I remember when that changed, and it used to look at a certain set of options, and they expanded it and changed the particular options contracts it was looking at. That happens, and the market changes, the market structure evolves, and you have to adapt the indicators as a result. So what the VIX is doing is it's actually looking on options on the S&P index futures, and it's actually looking at options about 30 days to expiration, 20, 30 days, somewhere in there. So it's been kind of a month out. And it kind of has done that traditionally by intention, because the ones, the right before expiration, a lot of times can get really noisy and sort of, weird things can happen that can skew the volatility data. So by looking at options just a little bit out, it sort of minimizes the impact of that. And so the VIX is basically looking at option volatility, and it's basically an implied volatility. So it's looking at volatility in options and implying the volatility of the underlying index, of the underlying contract. And this is a common technique with equities. You can look at an implied volatility based on equity options, right? Looking at the options on an individual stock. It's a common technique. So the VIX is kind of like looking at a volatility reading for the overall market by looking at the index options. Now, it's been an interesting environment because the VIX has remained pretty low at a time when it feels like the VIX should be higher at times. And this is actually a source of great debate. As I answer this question, I'll tell you that the nature of how the changing market structure has impacted something like the VIX is not really well known, and it's not clearly known ahead of time. It's hard to sort of figure out or model what's going to happen to the VIX if we have zero DTE options, which is what we'll talk about here in a minute. So, some have said, like Andrew Thrasher, who was on my show this week, has made the point that, look, it's just a low volatility environment. That's it. There's nothing crazy going on. Other people that I've talked to that are options traders say, yeah, the VIX is acting different than it normally has, and something's up. And they would blame the zero DTE options. Now, we have a couple other newer indicators, VIX9D and VIX1D. Now, these are different indicators which are now looking at, options with 9 days to expiration, options with 1 day to expiration. And so this 1 day volatility index is really looking at the zero DTE options, looking at short-term options. Now, what's happened is these options were just recently released. So this is probably not a great chart to even show it, but there's just not that much data. They just started this index about a month ago. What this is basically doing is now we have 3 different indexes tracking volatility. So it's sort of the VIX on 3 different time periods is what we can actually do. Now, what's the interplay between these? That's a really good question. I'm not sure yet. I could see a scenario eventually where you have a chart with the VIX 1D, the VIX 90, and the regular VIX, and you put them all together. There's a VIX for the NASDAQ, there's a VIX of the VIX, there's a lot of other things we could probably chart, and maybe there's a whole deeper dive into volatility that we can do at some point. So the short answer to your question is yes, we have all of those. It's $VIX is the regular VIX, which you probably know. $VIX 1D and 90 are the other two that you were asking about. And this is what I think you call the new daily VIX. And so the difference is it's looking at different contracts, different expiration. This is really focusing on the short-term volatility in the options market for the S&P index options. You know, what is I can't tell you with great authority or expertise what the impact of these is going to be, because I think it's still, pun intended, uncharted territory. I think you have to wait for more data to really understand this. But, you know, some have speculated that the regular VIX is becoming a little less volatile because a lot of the volatility that would normally be expressed in that part of the options market has now been drawn into these very short-term options, these 0 DTE options, which are now the most liquid options in the market. And so you have a ton of new investors there. They're very, you know, pretty noisy, but again, still very, very new. And so I think TBD, I think it's to be determined what the impact is going to be, but this is where I'm going to track it. I'm making a note to make a better VIX chart combining all of these things, because I think that could be kind of cool. I'll share with you any results that I come up with as I analyze them. Next question. If there's a triple top and the price hasn't broken through yet, what indicators should we use? And you went on basically to say, you know, what should you use to determine where the potential direction is? And that's a really good question. I don't have a good... I mean, I guess I would go to something like an Apple or like a Coke or something. These are more quadruple top kind of things, but, you know, similar pattern to what you're talking about. So you're basically saying when a stock is hitting a big resistance level like this, what can you use to figure out if it's going to break through or if it's going to stall out here? And you mentioned things like MACD and RSI and all of those. Really interesting question, and here's some thoughts on that. So overall, I think focusing in on this area is incredibly important, and we often refer to stocks like this and focus in on key resistance and support levels. It's a really important part of our discipline, you know, to look at where we're at and look to the left. I think it's a very powerful way of recognizing what levels have been meaningful for a particular stock at a particular time, and recognizing that the market has memory, and those levels that have been important tend to continue to be important until we break through them. And I think the recent move in a lot of the consumer staple stocks, and arguably things like Apple and others that are still sort of testing those levels, I think just reinforces the importance of this part of the toolkit. Now, what can we use? So number one, be aware that that level is coming and expect some sort of, you know, at the very least, short-term reversal. That's what we usually think of, right? There's usually, at the very least, some sort of short-term pullback. And I think that's what, you know, I would kind of be expecting here. The question is what happens next. And so I would say the way that you sort of gauge this, you know, number one, I think it's as simple as expect the level to hold until it doesn't, which is why when a market gets up to a level like this, that's usually not where I would suggest taking a new position, taking an additional position. You're going to wait until the level's broken, right? So on a chart like Coke, getting above 65, getting clearly above these levels and showing that we can follow through above resistance, it's worth waiting for that confirmation, right? So, you know, predicting it ahead of time is actually incredibly difficult. Many people will try to sell you some strategy that lets you figure out, you know, tell the future and know ahead of time what's going to happen. I have not found those to be particularly reliable. They work sometimes, and then they colossally fail other times. I'm much happier being patient and waiting for confirmation. That's what you got to remember, right? There are two ways to go about this. You can anticipate the move and sort of bet on it happening and then just have a stop in place in case it doesn't work, or you wait for confirmation. I tend to wait for confirmation because I've just seen this way too many times where a level holds and then pulls back. And so, I think so. So expecting resistance, and then if it breaks above 75, that's your all clear signal. I think that's really powerful. So what I tend to do is set price alerts for that level. So if and when it's broken, that tells me, something's more positive may be happening. In terms of other things, you mentioned RSI, which can be a very valuable tool. Seeing if it's overbought as it reaches those levels is one way. Again, I would bucket that in sort of a leading indicator sort of category. So the fact that the RSI is overbought as it reached this level, is maybe suggesting that it's already run so much and it's had such a strong move that maybe you need a bit of a pause. Personally, that's not my favorite way to do it. Again, just because a lot of times stocks will become overbought just by the nature that it had to get up to that level. So the overbought condition just recognizes that it's gone up a ton. I don't necessarily think that's a great approach. But what I would say is when you think about RSI and MACD, they're very good about telling you when it doesn't work, right? When a resistance level is holding. Because the RSI becoming overbought tells you we've gone up a bunch. When it comes out of that overbought region, that's the sell signal, right? That's the signal that the market has been going up a ton, and now that upside momentum is alleviated. So as it's holding here, you're getting the RSI telling you that the momentum is actually drying up, and I think that's a very powerful signal. Something like MACD isn't going to signal until we turn lower, and I'll add this on here just so you can see what I mean. The MACD indicator is great for a signal that the top is going to hold. All right, and so I would say indicators like RSI and MACD aren't as good for predicting whether or not it's going to hold, but they're great at confirming that a top is actually holding. So I tend to use RSI and MACD as defensive signals in this sort of environment. If they trigger a sell signal, get out of the way, and then wait for a confirmed break above that level. That's how I would generally approach something like a triple top or a quad top, I guess you could call that. Dave, how can you use ATR or ADR for position sizing? And if you're not familiar with those phrases, ATR is average true range, ADR average daily range. And the difference between this, we can stay with the chart of Coke. ATR, average true range, we have as an indicator. We don't have average daily range as an indicator, I don't think. But most people don't really refer to that because average true range really is the best way to think about a daily range. So a daily range is literally the height of the low, right? What's the height of each of these daily price bars? Let me switch. Hold on. Let me switch to just 1 year here because it's a little easier. Average daily range would just be the height of each of these bars. Average true range is that same thing, but it adjusts for gaps. So the average true range of this particular bar is actually that day's high down to the previous day's close because we gapped. So basically gaps have more of an impact, which is good because if you have a really gappy chart, the average daily range doesn't include those. So basically assumes they didn't happen. And so that's a little misleading because that is part of your experience holding the stock or analyzing the stock are those gaps. And so ATR, average true range, is what I would suggest. That's sort of the convention for understanding big moves in or the general range of a move. So how would you use ATR for position sizing? This is the 14-day average true range, which is a good starting point. Here's a general way I would think about it, right? If you think about having 10 stocks in a portfolio, which I would, let's make it 50 stocks in a portfolio. So if you have 50 stocks in a portfolio, you put 2% in every position, and that's going to be 2% of your portfolio in 50 different stocks or ETFs, and there's your 100% of your portfolio, right? And so that is an equal weighted or a dollar weighted portfolio, meaning you have an equal allocation of your portfolio, an equal allocation of a percent of your portfolio to each of those ideas. Here's the thing, a 2% position in a biotech name, and I'm looking at AMZN, but think about something like a really a noisy biotech name, and you will have a huge average true range. Again, if something's really noisy, really choppy, right? So this is monolithic power system, semiconductor name, pretty choppy, pretty noisy, a lot of movement. You can see the average true range on the stock. Compare that to something like a utility stock, Southern, or one of these kind of names that has less volatility. The problem is your 2% position in the utility stock is not going to impact your portfolio much at all. It's probably just not going to move that much. Your 2% position in a small cap stock or in a biotech stock or an emerging technology name is going to be incredibly noisy. And so as a result, you're basically, those two positions don't have equal exposure to risk. Risk as being defined by volatility. So the general rule is the higher the average true range, the higher the volatility, the smaller the position, because then you have an equal weighted position, equal risk weighted position, as opposed to equal dollar weighted position. Easy way to do that is put a bunch of, put a portfolio in Excel, bring in just the average true range or, some sort of volatility data. There are a number of different ways you can do that. But find a way to just standardize what is the movement expected in this stock versus the other one, and then allocate your percentages based on the relationship of those values and make sure that you're putting more in lower volatility positions and less in higher volatility positions. That will spread your risk evenly around your portfolio, and as a result, you'll actually be able to, you're actually making a better equal bet on each of those different stocks based on what they tend to move. I hope that it's a tough one to explain without showing you some big Excel sheet, but that's the best I can try. Next question. Is the S&P resistance at 4179 or 4200? I love that question. And again, I don't know who this was that asked this. I don't know you, and I don't know your personality type, but you remind me of people that I've known. Tom McClellan is one that I've argued greatly about things like this. Tom is an engineer. He's a former helicopter pilot in the military. He is very detail-oriented. He's very left-brained, very cerebral about his market analysis, and very big on the numbers and the details. Tom DeMark can quote particular price values on particular dates for the Nikkei 10 years ago, and that's where he's at. That is not me at all. I am more of a right-brained creative thinker. I'm more of a big picture thinker. I'm more into patterns and psychology. And I love how charts can help you quantify that in a measurable way, which is why we're all drawn to technical analysis, but I think coming from very different places. So, my point is, some people and more, I think, left-brain analytical people are very focused on particular levels. The market should find resistance at 430, 43, 24, 28, because that is the actual August high. And I actually don't even know if that is. That's as close as I could draw the line on our platform, but it's right around there, right? Even by what I just said, you can hear how I do not buy into the precision of these markets. What I would tell you is a lot of the technical tools that we used were created 50 plus years ago, in some cases hundreds of years ago, at a time when stocks, the structure of stock trading was very different, right? Stocks traded on eighths, which meant, 12.5 cents was the minimal gap, the minimal shift from one trade to the next, right? It was either the same print or it was 12.5 cents away. Now we're adjusting, we're having trades at, thousandths of a penny type of moves, right? Sub-decimal trading. And so the expectation that the market would hit a precise point and find resistance at that precise point, I think is laughable in 2023. If you read like the Edwards and McGee book and others, they will talk about a precision you can expect. But again, in their world, when they're writing this, it was very reasonable that a stock would hit $10.50, and you would expect buyers to come in right at that point because they just didn't have a lot of options between $10 and $11. Now we have basically innumerable options between them in terms of levels to execute at and where trades can be placed. So I think if you're expecting precision from the financial markets, I don't think that's it. I think you will be frustrated. So I tend to think of things as generalities. I tend to generalize in a big way because when I see this move in August, I don't see it as a move to 43, 24, 28 or whatever that exact print is. I see it as a move right to 4,300, and right about there, buyers are kind of exhausted and sellers come in or whatever it is, but basically around that point. And so I tend to think of things as having a big area, which is why I tend to think of support and resistance zones as opposed to support and resistance levels. I would see the December 2022 low on the S&P and the March 2022 low as a retest of 3,800, even though they're like 50 points away from each other. But in visually looking at this market, that's what it is. I don't see how you could interpret that as anything other than that. Honestly, I think you have to embrace that. Arthur Hill showed me a great trick on StockCharts about how to do that, which was I tended to draw lines for support and resistance levels, and I was, it was always, the market would kind of move, would be near there, it would be a little above, a little below, and it just felt super inaccurate relative to how I was perceiving it. And he showed me how to draw support and resistance ranges, right? And that's why I have these sort of colored areas. That was an Arthur trick, which I think is fabulous. The way you do that, by the way, click on annotate, and you probably use the trend line and horizontal line tools, which are great in certain cases. I tend to use a rectangle. So if I want to highlight a particular zone, I kind of do that. And then it really more, I think, accurately represents what the market is like in 2023. So is the S&P resistance at 4179 or 4200? I think that's, I don't think that's a meaningful question. I don't think that question could, sorry, that's a great question. Thank you for asking that. That's not what I meant. I think that's not I don't think you could argue whether or not those are the same. I see that as the same. I see these as a retest of 4200, and I think that's the resistance level. That's why that big green line there. And I think this is just a really close test, a failed attempt to get above that resistance. Now, that is my philosophy. You listen to others, you will get a very different take on things, but that is how I have stayed sane in these imprecise markets in 2023. Next question. So many of your scans work for stocks, but not for ETFs. Why is this? That's a really interesting question. And so the short answer is I actually tend to take the ETFs out of it a lot of times. I'll show you one of my scans. So let's see. This one is new swing highs and new swing lows. I run this scan every week for my market misbehavior premium members because I'm looking for basically large cap stocks and mid cap stocks that are breaking to new swing highs and new swing lows. And so I run these all the time. Now, look at the actual language in my scan. It's a stock. It's traded on one of these exchanges. This is the line that basically says the close is the highest that it's been, or basically it's higher than last week's high close for the last 13 weeks. So basically making a new 13-week high. The market cap's above 5 billion. That's scaled by millions. The type is a stock, so it's not like a fund or something. And the group is not ETF. So the way we've done this is we've created a big group because ETFs really are traded like equities. They're listed on equity exchanges, and so you have to filter them out. So we have a group called ETF, and I basically say it's not an ETF. I do that because I have a separate scan where I'm looking at ETFs. So you can see them down here because I'm just not a fan of having stocks and ETFs commingled in the same screen. Take this argument out by putting the little slashes here, and ETFs will pop up just like stocks do. And a lot of people like doing it that way. I just, a long time ago, found that I like thinking about ETFs as one bucket, thinking of stocks as a separate bucket. Because often I was trying to do work on individual stocks and sectors, and having ETFs just muddied it up a little bit. So there are very few scans that would work for stocks and not for an ETF. The things that wouldn't work is if you have any sort of like fundamental like earnings data, or things like it has to be in a certain industry or a sector, because ETFs aren't classified by industry or sector. So sometimes an argument you would put in here, a parameter, would automatically kind of filter those kind of things out. And that's why you might not see ETFs in a scan. But if it's just looking at price and volume and technical indicators, anything that works for a stock probably is going to work for an ETF as well, because they're pretty much trading the same. Next question, Dave, do all the indicators and scans out there really give you an extra edge? And you went on, you had a long question about, you see promotion and advertisements for scanners and indicators, unusual options flows, and all of those that you can pay for. Do they really give you an extra edge? Here's my take on those kind of things. And listen, I've gotten to know a lot of people that have created a lot of indicators. Some of them I think are absolutely fantastic. We feature some really interesting analysts and traders and their indicators on our platform, on the ACP platform on StockCharts. And I would say some of them are absolutely meaningful. I will tell you there are way too many indicators and approaches out there for you to use all of them. And here's my experience, and I will maybe use an analogy of my time at Fidelity, where there were growth managers and value managers. There were managers that traded a lot of small cap stocks and a lot of large cap stocks. and everyone in between. And I found that there were times when each one of them did very, very well, right? There were times when growth approaches would just be in favor. There were times when value approaches would be in favor. There were times when our quantitative models, our alpha models would work incredibly well. There would be times when they just absolutely struggled to do well. And that is the nature of pretty much everything. I will tell you that for things like stocks with unusual options, options activity, for dark pool analysis, for any of the indicators that we use, I will say that, you know, some of them will probably work very well. None of them work incredibly well all the time. That is the holy grail indicator that just doesn't exist. Any marketing implication that this indicator is I think factually incorrect most likely, and using data in a way that makes it seem better than it probably is. One thing I found, I mean, market analysis and technical analysis is not a 100% or even close to that sort of activity. It's frustrating, and on average you have to plan to be wrong about half the time on average, right? If you're sort of an average investor, you're going to be wrong about half the time. And so I learned a long time ago, investing is not about being right all the time. It's about admitting when you're wrong and unwinding unsuccessful positions. It's about recognizing when you're right and leaning into those positions. That is how you do very well over time. And Peter Lynch told me that a long time ago when I had a chance to work with him. He's like, it's not about being right all the time. It's about being right a small number of time and being really right when you're right, right? It's not about hitting a home run every time. It's about having a home run sometimes, and the other times just not striking out a bunch. And so I think what you have to remember is I don't think all of those things are certainly going to give you an edge. What I would suggest is find one thing, find your toolkit, find your approach, and stick with it consistently. And I would say one of those things, even if it's imperfect, if you use it consistently and with discipline, you're probably going to do much better. A lot of investors jump from thing to thing. It's like diets and fad diets and switching from one to the next, and you never really consistently have the weight loss that you probably want because it's sort of it's sporadic. And that's what a lot of, I think, indicators and indicator heavy approaches, you know, advocating one particular thing and that's all you need. It's challenging, but finding a good process and sticking with it is what's most important. The charts and the tools that I show you are the tools that I advocate for my premium members of Market Misbehavior. This is the toolkit that I've developed. There are a lot of things I don't use, but there are a small number of things that I do use, and I use them consistently, and that has served me very well. Final question. What do you think of Amazon after its latest move higher? So standard disclaimer, of course, you know, not a recommendation. I mean, I think Amazon, along with other mega cap names, look incredibly strong. And I would argue that our major benchmarks like the S&P and the NASDAQ are not about the members of those indexes doing well. It's about the leadership. It's the generals. It's the big mega cap names that have done so well. If you look at the year-to-date performance of the Amazon and Amazons of the world versus other things, that's the story of the market in 2023. And I don't see anything on these charts telling me to not want to still be there, right? We talked this week about semiconductors with guests, with John Kosar. We talked about, you know, leadership areas of the market like the XLK and the XLC. Andrew Thrasher, we're talking about semiconductors, and you know, and with many others, we've talked about the recognizing where there's strength and leaning into that strength. The charts will tell you when the trends are no longer working. So if you ask me Amazon today, I would say this is a strong chart in a small number of strong charts, and I would be inclined to stick with charts that are working until they stop working. At this point, the chart is telling you onward and ever upward. We'll have to finish there, folks. Thanks for joining me on a special mailbag edition of The Final Bar. Be well, stay safe, have a great one, and we'll talk to you again soon.